Finally, some actual examples. We've looked at a couple of generic examples of deferrals that are going to require adjusting entries and accruals that are going to require adjusting entries. So now what we're going to look at are some actual business transactions for the company that we've been studying, Net Solutions. And then we're also going to look at what impact not making these adjustments would have on the financial statements. In other words, is our net income going to be overstated or understated? What about our assets? Are our liabilities going to be overstated, understated? Same thing with the assets, okay? So let's go ahead and get into those examples now. The first one that we have is for accrued revenues, okay? And it says, assume that Net Solutions signed an agreement with Dankner Company on December 15th to provide services at a rate of $20 per hour. As of December 31st, Net Solutions had provided 25 hours of services. The actual revenue, this is earned revenue, will be billed the next year on January the 15th. Okay. So this is a situation where you know, if they had provided these services, say, let's say between December the 1st and December the 14th, they had provided 25 hours of service. This would not be an adjusting entry. This would just be a regular entry. It would look the exact same, but it would not be an adjusting entry. The only thing that would be different would be the date over here. This is a little bit different. This is a situation where the services took place between the two billing periods, okay, but it was earned in the current year in December, but won't be billed until the next year. That makes this an adjusting entry. So we take the $20 rate per hour times the 25 hours of services provided, and we just multiply that together. 25 times 20 equals 500. And that's where we're coming up with this $500 here. So our adjusting entry is we're going to increase the asset with a debit. Assets are increased with a debit, okay? And that's why revenues must be a credit, because everything has to balance. If you don't understand why revenues are a credit, it's because they're essentially forced into being a credit because the asset is the debit, okay? So we see the accounting equation impact. Assets have gone up by $500, and stockholders' equity has also gone up by way of revenue by that same $500 because these are services, okay? And any expenses that we have, those are just going to be on the income statement under operating expenses. We don't have to worry about those right now. All right. So, with that said, let's look at what would happen if we did not make this adjusting entry. What would happen is that for the current year, revenues are going to be understated by that $500. So whatever revenue we made for the year, whether it's $50,000, whether it's $50 million, doesn't matter. The result of that one little transaction not being recorded is going to understate revenues by $500. Now we're going to make the assumption that all of our expenses are correctly stated, okay? So net income is therefore understated by $500. Why? Because the expenses are being subtracted from a number that is too small. If the revenues are $50,000, they should have been $50,500. If they're $50 million, they should have been $50,500. Okay? So net income is going to be understated. This is all on the income statement. On the balance sheet, assets are going to be understated by $500. Why? Because we never set up the account receivable. That's not there. I mean, we may have account receivables on the books, but there's going to be $500 missing. Liabilities are correctly stated. We didn't introduce anything with regard to liabilities in this, but also notice stockholders' equity is going to be understated by $500. Why? Because if we remember, we have this R is going to stand for revenues. Revenues lead to net income, and net income flows into retained earnings. Okay, don't you love my penmanship? So if this doesn't happen, retained earnings is going to be understated by $500. Common stock's not going to be impacted, but retained earnings will be. Therefore, total liabilities and stockholders' equity is understated by $500. The understatement is only in the stockholders' equity portion. So not a good situation. All right, let's look at another example. This one deals with accrued expenses. And this is very similar to the example that I gave you in a previous video. It says Net Solutions pays its employees bi-weekly during December. Net Solutions paid $950 on December the 13th. We had this transaction in the previous chapter. And they also paid $1,200 on December the 27th. However, looks like the 28th and the 29th were a weekend. And it says, as of December the 31st, Net Solutions owes $250 of wages to employees for Monday and Tuesday, which occurred on December 30th and 31st. This is Monday, this is Tuesday. Okay. So, we have incurred the expense, yes? Therefore, we must record the expense, and we're going to do that right here. We're going to debit wage expense. Expenses always go up with a debit for $250. And then we have a liability to pay that $250 next year, about the 9th of the month, something like that, of January, maybe the 11th of January, something like that. So we're going to set up a liability for $250. Okay? So let's see what happens. Well, I want to before we go any further, I want to say one thing. Liabilities have gone up. Okay? Now, this increase that we're talking about right here, be very, very careful. I've alluded to this before. I don't want to clutter these things up with too many arrows, but this increase here is in reference to this expense. Okay? Stockholders' equity is actually going down. Okay? Equity is going down. The expense is what's increasing. Now, let's see. Looks like did I skip something here? Let's see. 2021. Okay. So then what we're going to do on, let me just look at one thing. Okay, very good. I'm going to skip forward to this slide, and then I'm going to go back. The effects of omitting the adjusting entry for the expenses. Well, this is kind of the opposite of what we had in the previous example. If we think about our income statement, let's assume that revenues are correctly stated at whatever amount. But expenses are understated by $250 because we would have never recorded that $250 for wage expense. As a result, net income is overstated by $250 because we haven't had enough expenses subtracted from the correct amount of revenue. So our net income is showing up as being too high. That's the income statement impact. Over on the balance sheet, assets are correctly stated. No problem there. However, liabilities are understated by that $250 because we never recorded the wages payable liability. Therefore, stockholders' equity in this case is now overstated by $250. Okay? And so you can think of this either way. Because liabilities are understated, equity is overstated. Or you can say, because net income is overstated, stockholders' equity is also going to be overstated by way of the too much net income. Okay? Either way, we have a problem. All right. So, eventually this is going to be the journal entry that we have to make. And this is a little bit heady for a beginning accounting class, but I just want to, I'm going to show you this to kind of show you that we don't always have one debit and always have one credit. I just want you to understand how we have to be willing to do the mental work to understand this, because accounting, especially in the beginning, is not easy. And if you're learning this online, that's an additional hurdle. So it says Net Solutions paid wages of $1,275 on January 10th. Now this is the next year. This payment includes $250 of the accrued wages recorded on December the 31st. So what does that mean? It means we can't expense this full $1,275 in January. We only expense $1,025, the part for the new year. And then we're going to debit the wages payable that we had previously set up because we no longer owe that money. We don't have that liability anymore. So it goes away with a debit. And now the cash, we're paying out $1,275 cash, so that is the full credit amount. Okay, if this slide is a bit much for you, that's okay. The main thing I want you to understand is this slide right here. If we don't make that adjusting entry, our net income is going to be overstated and our stockholders' equity is going to be overstated as well. Let's continue on with another example here. We had this transaction for Net Solutions in the previous chapter as well. It says December 31st unadjusted trial balance of Net Solutions indicates a balance in the unearned rent account of $360. And if you recall, the reason for that is Net Solutions had purchased some land. They spent $20,000 on the land, and then they found somebody to lease the land out to for $120 a month. And they received a prepayment or rent in advance payment of $360, so for 3 months rent. So this balance represents the receipt of 3 months rent on December the 1st for December, January, and February. Okay, however, at the end of December, one month's rent has been earned. Okay, not 3 months, but 1 month, because it was for December, January, and February. We have now earned the rent for December. These two are still unearned. So even though the transaction was for $360, that's not going to be the amount in our journal entry. We set this unearned rent, remember this is a liability, I can't stress that enough. We set this liability up correctly with a credit to unearned rent for $360. Now we're going to debit 1/3 of that, $120. Okay, that gets our balance, our liability down from $360 to $240. And because we have now earned this rent, we can go ahead and put it over on the income statement, rent revenue of $120. Okay, so here we have the accounting equation impact. Our liabilities have gone down and our revenue has gone up. Always a good thing. So again, let's look at what happens if we fail to make this journal entry at December 31st. Revenues are going to be understated by $120. Now, this is not regular revenues because Net Solutions is probably not in the business of renting land. They seem to be doing something else, but it is a revenue nonetheless. So total revenues would be understated because we didn't make the adjusting entry. It's all just sitting over on the balance sheet as a liability for $360. Our expenses are correctly stated, so net income is understated by this $120. Because whatever our revenue is, it's $120 too little if we don't make that adjusting entry. Well, over on the balance sheet, assets are correctly stated. Why? Because unearned rent is a liability. So the fact that we didn't make an adjusting, let's say if we messed up and we didn't make this adjusting entry, assets wouldn't be impacted. However, liabilities would be. Liabilities would be overstated by the $120. We set it up on December 1st, we had a liability for $360. That needs to go down to $240. If we don't make this adjusting entry, it's still going to show $360. And as a result, stockholders' equity is understated by $120. Again, you can think of that as being understated because liabilities are overstated, or you can think of it as being understated because net income is understated. However it works for you is how I want you to think about it. Okay, this video is getting a little bit long, but we're going to do one more example looking at prepaid expenses. It says December 31, unadjusted trial balance. Net Solutions indicates a balance in the supplies account of $2,000. If you recall, they spent, let's see here. They spent $1,350 on supplies. They used $800 of those supplies. Okay. That left them with $550, but then they went back and then they purchased another $1,450 in supplies. So that's where they're getting this $2,000 from. We've seen these numbers before. Some of those supplies were used during December and some are still on hand, in other words, not used. Assuming that on December 31, the amount of supplies on hand is $760, the amount to be transferred from the asset account, prepaid supplies or supplies, to the expense account is computed as follows. Supplies available, this is the asset, $2,000. This is what we actually have on hand, so we know that $1,240 have been used. This is going to be, and this is the amount of our expense. Okay? So here's our journal entry. We're going to debit supplies expense. For the 1,000th time, expenses are always going to go up with a debit. What has gone down? The asset has gone down. Supplies is our asset and it has gone down, so therefore we're going to credit it. Assets have gone down. Expenses have gone up, not equity. So the overall impact here on owner's equity, anytime you have an expense, is negative for stockholders' equity. This up arrow again is for the expense itself. Let's see here. Tell you what, let's do this. We've looked at this transaction. Let's see here. Okay, let's do one more. I know this video is kind of long, but these two are kind of tied together, so we better do it. Okay, December 31, we have a balance in prepaid insurance of $2,400. If you recall, they paid $2,400 for 12 months insurance coverage. At the end of December, the insurance expense account is increased, debited, and the prepaid insurance account is decreased, credited by $200. That's because they used the insurance for a 1 month period from December 1 through December 31. So we had a balance of $2,400, we're going to credit that by $200. So assets have gone down. Our prepaid insurance asset is now $2,200. Insurance expense was $0. We're going to debit that, and it's going up by $200. So the overall impact on equity is a negative $200. Expense goes up, equity goes down. Okay, so let's look one more slide, and then I'll wrap this up. Says if the preceding adjustments for supplies of $1,240 and insurance $200 are not recorded, the financial statements will be misstated. Assuming that revenues are correctly stated here, expenses are understated by a total of $1,440, these two numbers added together. Therefore, net income is overstated. Assets are overstated, okay, because supplies are overstated by $1,240 and prepaid insurance is overstated by $200, so that's a total of $1,440, and as a result, stockholders' equity is also overstated by $1,440. Why? Because net income flows into retained earnings, which is a part of stockholders' equity. Okay, that's enough for this video. We'll end this one and get another one started, probably one more for this chapter.